So real estate investing has a ton of attractive qualities. And one of the ones that I want to talk to you today about, Brett, is the passive income, the benefit of investing in real estate and the benefits of creating passive income. So I just want to start off by asking you, why do you think that investing in real estate is one of, if not the best ways to generate passive income?
That's a great question, Thomas. Um, yeah, so many things jump into my mind, like not only why, but when I figured this out. And the biggest piece to me, the easiest thing that stands out is stackable returns. And I think that makes this asset class so much different than other asset class when you're looking at investments on the stackable return. So I can talk about that. And then we can get into it a little further on each one of those things. But when I talk about stackable returns, I'm talking about multiple types of returns stacked on top of each other. So when I say stackable returns, I'm talking about cash flow. I'm talking about principal pay down because we leverage capital, and it stretches our money. It makes our money soldiers work harder for us. We've got principal pay down. We've got depreciation, and we've got one thing that we don't account for in our equations, our acquisition equations, but it's going to happen. We've looked at studies, and we can talk a little bit about this too. Appreciation is going to happen. It's just in our investment strategy for passive income. When we invest for cash flow, I'm not accounting for appreciation, but it will happen. So when I say stackable returns, Thomas, I'm talking about cash flow, principal pay down, depreciation, and appreciation. That's a pretty good stack of returns, right? What other type of asset class offers multiple types of returns like that?
Yeah, not any that I know of. And before we really jump into all these different things, the stackable returns, I think it might be a good idea to define what is passive income. Because I think that a lot of people can have a few different versions in their mind of what they think of when you say passive income. And one of the things that we've also talked about previously and we share with others is that there really is no such thing as 100% passive income. There are some things that are more passive than others. But maybe I'd throw the question to you as far as what you think passive income is and maybe your definition of passive income.
Passive income for me, Thomas, it makes money for me that doesn't require me to make money. So it requires none of my time to make the money. So in essence, it's literally the soldiers, and I think it's Kiyosaki that calls them soldiers, right? The money, it's going out there and getting other soldiers and bringing it back. So that the money is working for itself. And, when you're looking at passive income, you can syndications, ETFs, mutual funds, all of this stuff is literally passive income. Real estate can be too, but you have to watch out. Real estate has the ability to suck you in and create another job for you, right? Mm-hmm. And cash flow quadrant, another Kiyosaki thing. There's certain pieces of that quadrant where you're at. It's not income. Like if you are self-employed, you're not a business owner, right? You've paid yourself to have another job, basically. So you have to watch out for that in real estate where you have the likelihood of doing that. Where if you're investing in a mutual fund or syndication, not necessarily you don't have that opportunity to basically purchase yourself another job. So it's money that's being made without requiring your time to make it.
Yeah. No, I think that's a really good way to put it. And like you said, you got to be careful because you have the passive and then you have the active income, right? And like you said, real estate can easily become an active income source, meaning that you're spending time, maybe you're dealing with different problems and things are popping up, you're getting phone calls, whatever it is. And now it's no longer passive, it's active because it's taking your time.
So that's where we started, Thomas. And we started, just like the TV shows that you've seen have been popularized by, what's the HGTV, Flip This House and all of that stuff. That's where we started. We started going from flip to flip. At a certain point, we got up to 6 flips at a time. And that was active investing. And it took my time at that time, Thomas, I was the one out on the job site swinging the hammer and running crews. And it just got to a point where I couldn't get anything done because I was always on the phone. It was laughable when I got to a job site and put on nail bags or a tool pouch, because I wouldn't do anything. I'd be on the phone the whole time. And then once everybody stopped working at 5:00, boom, that's when Brett gets to work, right? So that's 100% active. And you hear it all the time too. You hear, well, I don't want to be a landlord because I don't want to fix toilets. Well, that's perfect because I don't want to be a landlord either that has to fix toilets. That's the choice of being active versus passive. But I mean, we're going to talk a little bit about depreciation. That's something that affects the way that you can, or that you're allowed to adjust your income too. Are you an active real estate investor or are you a passive real estate investor?
Yeah. And, I remember when we first met, I came to your office and I pretty much knew almost nothing about real estate at that time. And I started asking you all these different questions. I had probably a notebook full of questions that I just went through.
Spiral bound.
Yeah,
have a seat on the couch.
Yep. I remember it like it was yesterday. But you were throwing out all these terms, all these fancy words, and I was like, it was just all going over my head with like depreciation, appreciation, all these different things, passive income, active income. But now I've gotten a grip on it. So I think it's, for anyone who's listening, I think it's important for us to keep in mind that some of them may not already understand what these things mean and the implications of them. So making sure that we're clear and we're defining the words that we're using, I think is really important. Because I remember myself just being like, wow, there's so much to learn. I know nothing.
Yeah, absolutely. And diving into it too is, passive income, like I said before, is money that's made without you having to make it necessarily. It's money working to get money, right? In real estate, that ability to make it active, even when you're trying to create a passive, it's so possible because, depending on where you're at in your investing career, you get a good deal. A good deal is value add. Value add requires work. Well, it's only passive if other people do that work. So especially younger investors, will get into the sweat equity thing. Me coming through the construction industry, that's, I can do this, right? I can do all of this. I'm a licensed general contractor. That's where I got tied up in it. But even if you have a straight turnkey property I don't need a property manager. Well, guess what? The toilet does break. The toilet does need fixed, right? You need to replace a toilet. A light goes out. Water goes out in the middle of the night on Christmas Eve. There's things that happen. You have to have a property manager, a good property manager, to take that over so that it can be passive. So you can have sweat equity to add value. You can have sweat equity to manage properties. You should acquire these things with the understanding that true passive income does not require you to be a piece of it. Yeah.
And I still see and hear some people who are hesitant to go with that route of the property manager because they don't want to give up some of the profit. But then it comes back to, well, how valuable is your time? Because time is much, much more valuable than money because you can't get more time.
What's more valuable than time, Thomas?
I would say it'd be your attention, your focus.
Absolutely. So what happens if the things that you're skilled at in your life, the gift that you've been given, and your attention is on that, and then you get an urgent call because you're penny pinching, and then that takes away your time and your attention. So that attention piece is huge. With a property manager, I can have set times where I'm looking at it here. This is when we're talking. This is what we're doing. You have clearance up to this dollar amount. Handle this stuff for me,
Yeah. And even too, if you're thinking long term, you're going to have to at some point either build a property management company or hire it, because unless you stay at 1, 2, 3, you start getting in the double digits. I mean, you're doing that yourself. You just create another job for yourself. So
yeah, I found really right around, and you say double digits, as soon as even five properties, like you can't plan out when the leases come up and all of that stuff. Cause just imagine if you had 5 properties turning at the same time, it's going to be difficult. Sorry, just one second. it's going to be difficult for you as a person to advertise, show, background check, let alone one property if you have a full-time job, but try doing that with 5 properties, right? So there comes a point where it's like, it doesn't work. My journey, what I loved about my journey, Thomas, was same through engineering. So I went to school for architectural engineering, construction management engineering. And I always heard engineers knew everything, right? They draw a picture. They think they know everything. If it's on paper, then it's got to work, but they don't know the real world application of things. So similar to that path, I wanted to make sure I put my hands on everything. I don't know everything. I won't know everything, but I had experience learning what didn't work along the way because I got my hands in it. I feel the same way with property management, where I learned a lot because I was down in the weeds, sweat equity, learning what it took. In the book, How to Get Rich as a Doctor, we wrote about the first asset I did acquire and how bad I did managing that property. But I learned so much from it. So if there's a younger a doctor listening to this, and maybe even in med school or something, you talk a lot about house hacking. And that's a great way to learn the system. And I call learn and burn, right? I'm burning money, I'm burning time, I'm burning attention, but I'm learning. And it's a great way to build that foundation, because then now I can read all the books I want. But it's until I apply that I turn knowledge into wisdom. And through that experience of applying that, that's when now I have 5 units. And I know this are the questions that I need to ask property manager to see if they're a good property manager or not, because I experienced that.
Yeah, I think that's important. There's so many, you can read all the theories, but until you actually do the experience, you're not going to really fully understand the implications and the nuances of all the different details. So, but let's go ahead and dive into some of those benefits that we were just mentioning at the beginning of investing, or real estate investing for passive income, the stackable returns that you mentioned.
Well, everybody knows this one. We always put this one right on top, Thomas. What is cash flow?
Yeah, cash flow is the money that you get every month that's income coming in. Of course, you have the gross and then the net, which is more important. How much are you actually keeping after the expenses?
And the net is the cash flow, and anything else besides that is just a number on a spreadsheet, right?
Yeah,
because it doesn't matter how much money you make, because what's more important is how much money you keep, right? Yeah. And cash flow is that arbitrage, that difference, the net that you bring in. It's that mailbox money. It's what's going into your pocket. And cash flow is awesome, even in running a business. And if you should be running your investment portfolio like a business, right? What does cash mean? Cash is king, right? Cash is awesome because you can operate then. If you don't have cash, then you can't operate. But when you have a steady flow of cash, that's even better. If I know I'm getting this much money every single month, that's amazing.
Yeah. And that's the only way to create financial freedom, is by building up your passive income to a point where it exceeds your expenses. And now you no longer have to continue to, if you want, your full-time job or your active income, whatever that source income looks like.
Yeah. So we talk about leveraging capital to do this. So there's 2 different ways. There's a few different ways that I've seen people acquire rentals for cash flow. You've got the cash guys who buy all cash. A lot of times I'll see them sit in on lower end properties, lower tenant class. Sometimes you see them sit Section 8 areas, that kind of stuff. And they look at, when am I getting my money back, right? And I think a lot of the guys will love to see returns. I'm not that kind of investor, so this is not my particular investment criteria. But I know that a lot of guys will like to be all cash in and get their cash back in 2 years, in 3 years, in 4 years. So that's one way of looking at it. So you've got cash in, and then your net is a lot higher because you have all that cash in. I don't have a mortgage payment, right? I don't have interest to pay. I don't have principal to pay. Hopefully you're not paying PMI on something like this, but so that cash flow is going to look bigger in that scenario when you're all cash purchase. Then you have cash to purchase, and then refinance, which we call the BRRRR strategy, or you can finance right out of the gate as well too. And when you finance, you actually apply leverage. And this is another unique piece of this asset class, is being able to apply leverage. Because really, how much money can you borrow to go buy Tesla stock, right? How much money can you borrow against your Tesla stock? There's some ways to do it, but nothing near being able to leverage on a tangible asset, real estate.
Yeah. And much more risky too. With something like a stock and tied to the economy, it can just like that in one day sink, cut in half.
Gone. Yeah, no insurance on that. But we're talking about the cash flow. So when we do leverage, then we've got principal that has to get paid and interest that has to get paid. Obviously, in a net scenario, we're paying insurance. If there's any type of, if it's a duplex, tri, quad, or whatever, you've got utilities, any type of landscaping, snow clearing, that kind of stuff all has to go in there to get to your net. So your net is going to be a little bit smaller because of the principal and the interest, but that arbitrage, that difference is what the cash flow is. And your acquisition should be based on, I say, worst case scenario, conservative perspective of what's the acceptable amount of cash that you want to see per door. What is that number for you, Thomas? I'm going to put you on the spot.
Yeah, well, I know that when we're working with our clients, we look for at least $200.
And 200 is a turnkey scenario, right? And this, again, going back to that sweat equity piece, is like when I'm doing that, I'm putting my sweat equity in there. I got to have a little more for my door. You know what I mean? On a turnkey scenario, if I need at least, and I'm taking worst case scenario, had a new friend of mine use this. I'm conservative because I'm cautious. And I love saying this because when I look at, so we'll look at two things when we're comparing properties to make an acquisition. We're going to look at market rent and we're going to look at market value. And I'm going to take, typically, we're going to get a range, in market value or ARV, we're going to get maybe a $10,000, $15,000 range. In market rents, typically we're seeing $100 to $200 ranges. And we're 2,000 and down on these rents. ARVs, max ARV for us typically around 200, but could get up to 250. So this is the ranges we're seeing. I'm conservative because I'm cautious. I'm going to take the bottom side of that range. So I know worst case scenario, I love putting that out. I say, hey, worst case scenario, are you okay with this investment performing at an 8% cash on cash return? Worst case scenario, right? And then what I want to do is also look at the anticipated case. I'm going to make my acquisition on the worst case, but I'm going to push my team to get the anticipated case when we're actually implementing.
Right. Yeah, and I think just highlighting the fact when you're using leverage that not only are you limiting the amount of cash that you have to keep in the deal, but you're also providing that equity so that the value of the property is increasing. So just for anyone listening, for the example, let's say you buy a property, 100,000, or let's say 80,000, 20,000 in repairs. So you're 100,000 in, but the value that after repair goes to 150. Now, when you refinance it, you're able to pull out up to, an 80, 90% loan to value typically?
Depends. Yeah, it depends on the lender and depends on the asset class too. It's going to be a little different between single family versus duplex versus triplex versus commercial and all that. But if you run your numbers safely at 75%, then you're going to be happy. Right. But different ones to end market conditions. Not going to get too far into the weeds on it, Thomas. There's so many things that lenders will assess their risk off of. And, typically those are going to run from all the way down to 60%. And some of our lenders will actually go up to 90% too.
Right. So for this example, let's say the 75%.
Safe. Yep.
This is an extremely good deal, the example that I gave, because 75% is actually 112,000, which we said you are all in at 100. So really you're actually pulling out, in some rare instances and really good deals, you can actually take out more cash than you put in, which I think is one of the biggest and in my opinion, one of the best benefits of value add refinance strategy.
Cash out. Yeah, pull it out. Thomas, how much in taxes do you have to pay on that 12,000?
I'm not sure. I'd have to talk to an accountant.
Nothing. No, it's debt. It's not real money. It's paper money. It's on your books as debt. So that's another massive benefit of this. And a lot of times you'll see these types of deals in sweat equity scenarios. We've done them where we've actively acquired, we've actively found, we've actively acquired, we've actively renovated, right? And we'd even manage them out front. So we have this ability to show debt on the books, but in my pocket, it's cash. I don't have to pay taxes on debt. That's really interesting piece of the cash out refi.
Yeah. Yeah. So that makes
you can do this in commercial. I mean, you can do this big time in commercial. So in commercial, we call it priming the pump, the air equity piece. And when we do that, we create this equity. In commercial deals, it's different. It's based off of the income of the property, right? It's not on the market value of the property. It's the income of the property that generates the value of the property. So if I can show by putting in washers and dryers, renovating a few units, increasing rents, boom, there goes the value straight up on an appraisal, because this building is worth this much more now because it brings in this much income. So now on the single family residence, which is great if we can pull out $12K tax-free. Look what we can do in commercial. 6 figures pull out. I know some multifamily guys pull out big chunks of money tax-free like that, and it makes sense. And hedge funds, we talked a little bit about hedge funds. I don't know, have we talked about hedge funds on any episodes yet? Not yet, right?
No, I don't think we have.
Talk about it so much. My conversations never stop about real estate. In the sauna this morning at the gym, talking about real estate, personal development. It's awesome. In a hedge fund scenario, looking at, I've never worked directly with a hedge fund. I only know from the outside looking in that they may use a similar scenario where they acquire with a certain acquisition equation that allows them to pull all their capital back out, which in the same regards, then they're buying for cash flow, but they have no money left in the deal. And that then is called infinite return.
Yeah. Yeah. So there's all these things, all these huge benefits, and there's nowhere else that you can get these attractive qualities that we're mentioning about cash out, debt free, paper money, and all these things besides real estate. So that's really exciting stuff.
Yep. So we kind of lead into the next one, and the stackable returns is principal pay down. So when we're leveraging debt, we have a mortgage that needs to be serviced, right? A note that needs to be serviced. And who services that note for us? Thank you, tenant. Yep. Tenant pays rent that we pay the mortgage with. And the acquisition equation is where we lay out this arbitrage. We create this cash flow above, right? We have this gross rent come in. We subtract all of our expenses, taxes, insurance, utilities if I have to pay utilities, any landscaping that I have to do. We actually hold back 5% for vacancy and 5% for maintenance as well too. 10% property management. I figure out all of this stuff, and it leaves me with gross income, right? After those expenses are left off, if that's the perfect word for it. But then I have to remove then the mortgage payment from there as well too. And that's what's left with the cash flow, the arbitrage. But remember, when we pay down that principal is going to our balance sheet because it's paying down the note on the property, which turns from debt to equity, right? So now as that tenant pays down the principal, this equity buildup is showing on my personal financial statement, right? On the asset side. So I love principal pay down. And if you've ever looked at an amortization schedule, when you take out a loan, obviously you're paying much more interest first, which really brings you no value than access to the money. And then your principal starts really low. And you'll notice that as you start year after year after year, you're paying more principal down. So you're adding more equity to your balance sheet, and you're paying less interest over the years. We talked briefly about there's this unique spot where people have a tendency to sell properties. I believe it's around 11 years. And it's just after that where the amortization converges, where interest starts dying and principal starts rising. So a lot of people tend to stay in their primary residence in that high interest rate of the amortization cycle.
Yeah. Yeah. And the other beautiful thing when you're building that equity, or rather the tenant's building that equity for you, it's not instantly available to you, but you can use things such as HELOC, and you can also refinance in the future. So you can then pull that back out in cash and purchase more properties, or really anything that you want with that money. So I think that's a really beautiful thing that you can do, borrowing against the equity that you have in your investment properties.
Yeah, that's a great point. And it brings up another benefit of residential real estate as well, too, is the liquidity of it, right? When I tell everybody, we always mitigate our risk in this asset class, because who can buy a residential house?
Anyone.
Well, not anyone, but a lot of people, right? A lot of people, more than any other, right? How many people can buy a 100-unit apartment building, right? Even if you have the money, you still have to have the experience to do that, right? So, or a 8-unit apartment building, or even a duplex, right? Duplex are still right in there. Really, once you break that 4-unit up into 5, where it's considered commercial, that gets more difficult to acquire. But it's liquid. I can sell it to anybody. I call the chuck in the truck, first time home buyer, grandma and grandpa downsizing, a landlord doing it for themselves. There's so many people that can buy this particular asset class. So I say it's not liquid. It's definitely not illiquid, but we can move our capital fast if we need to. And then you touched on HELOC. I can actually borrow back out of that house. I can borrow against that. And interesting piece, when we talk about financing here, HELOC versus, when we say HELOC, home equity line of credit, HELOC, we talk about that versus a mortgage, 30-year fixed mortgage. The way the interest is applied is different. So a HELOC is, I believe it's a simple interest. I believe that's the way it's paid, versus the 30-year fix, where we're compounding interest. So there's interesting, I know there's a couple of outfits out there that leverage the two in order to pay one down faster. But it's just another opportunity for you to pull your cash back out of it, because it's a tangible asset. It's attractive to loan against because it's tangible. Nobody's going to take it away from you.
Yep.
I've never heard of a house stolen before, right?
Yeah. And all the banks, they have all the trust in those types of assets. That's why they put out all these loans and all these mortgages for people to buy it. If you were to get a loan from a bank for a business, it's going to be much more difficult than for an asset like a house, because a business is much more risky versus a property where you can say this is the value based on the recently sold for single family, or like we were talking about, cash flow for the bigger multifamilies.
Yep. So principal pay down, very interesting piece. I love that piece. And the next one in the stack is depreciation. I mean, we could talk for an hour on this, then we could have special guests for weeks on this as well too. So I'm just trying to think of the easiest way to put this together to share. Let me first by saying I am not a certified public accountant. I'm not a financial advisor. I speak of my personal experience when it comes to this stuff. So when I look at depreciation, Thomas, I think the easiest high elevation perspective of this is there's something called straight line depreciation. And we can depreciate single family real estate for 27 and a half years, a little different than commercial, but single family is 27 and a half years. And when I say straight line, I mean the taxable value of the property less the value of the land. The value of the land cannot be depreciated. It doesn't depreciate for being used. So you got to pull the land value out. The property itself, we're going to depreciate that. And we take the fair market value, say, of the property is 120. We take out maybe 10 for the land or whatever, that 110 that's left, I then divide by 27.5. That gives me a number. Then, what is it?
4,000.
$4,000. So I take that 4,000, then I multiply it by my tax bracket, right? So if I'm at a 37% tax bracket, I multiply 4,000 times 0.37, gives me a number. What is it? $1,480. So just very simply looking at this, I could write off $1,400 a year of my passive income at that point, right? I can't, if I'm not a real estate professional, if it's not a short-term rental, I can't use my passive losses to reduce my active income. I have to be a REP, a real estate professional, or it has to be in short-term, which I believe is 3 days stay or less on average.
Yeah. And that's just keeping everything surface level, like you said.
Yes.
To put it super simply, it just lowers your taxes, your liability of taxes paying at the end of the year, which is a beautiful thing because taxes is your biggest expense.
And I'm going to go into this just a little bit further. I am a real estate professional. I spend at least 750 hours a year in real estate. At least 50% of what I do is real estate. And my wife is also a real estate professional as well, too. She's a licensed real estate salesperson. So we qualify for this title, right? So doing that, we can actually offset active income this way, too. Very interesting. And we also have Airbnbs as well, too. So there's lots of things that allow us to do this. Now, there's major benefits to this. And for the physicians out there, I think it's interesting. A lot of physicians marry physicians. And it's probably like that in a lot of industries, right? You're around doctors all the time. You live at work, right? So sometimes you don't have the ability to become a real estate professional. So maybe you could use that short-term rental to cross the line, to use your passive losses to adjust your active income. And that's just one of the big ways. So it's in my mind now, I'm trying to figure out, hey, what are some creative ways that we could do this to help physicians who do have spouses that are able to qualify as a real estate professional, because that is a game changer. If you have the ability to do that, please look into it further. Becoming a real estate professional is probably much easier than what you think it's going to be. And reach out to us or, I don't know, who else would you reach out to figure out what is a real estate professional? Your certified public accountant. Yes.
Yeah.
Yep. Absolutely. To see if that's a possibility for you, because I guarantee that will change your life, being able to offset your active income through real estate.
Yeah.
There was one other thing, Thomas, in depreciation that I love, and it's actually, I learned it, the saying from a white coat investor. And when I heard him say it, I was like, wow, that makes sense. So the idea of generational wealth has intrigued me. I come from nothing. When I say nothing, I mean no finance, no business background, none of this. I didn't have any of that growing up. So I think it's natural human nature that we want to create this and give it to our children, right? So it's attracted me to learn this. And I think real estate by itself is a great way of building generational wealth. And one of the reasons is this depreciation piece, because watch this. With residential real estate, we can also do what's called a 1031 exchange. Mm-hmm. And the 1031 exchange allows you to continue to kick the can down the road. And that's when I say depreciation is kicking the can down the road. I don't have to pay taxes on this because this piece of the code, right? But what happens when you do depreciate something, when you sell it, you have to what's called recapture the depreciation. You have to pay it back. It goes back to your income. So the 1031 exchange allows me within a certain time period to exchange the investment from here to here, from property A to property B. I have a certain time frame they have to do it. It has to be a similar type property. I believe the similar price range. So there's restrictions or stipulations to this. But what this does is it allows you to continue to kick the can down the road. You do not have to recapture the depreciation. So this gets really interesting. Watch, you can depreciate. Say you've got property A, you depreciate that, dude. And for me as a real estate professional, I can even do what's get some bonus depreciation. I can run cost segregation on this thing to increase the amount that I can depreciate faster between, I believe, is 1, 5, 10 years. And instead of 27 and a half, I can increase the depreciation on this thing. So now maybe I can write off 20 grand on this property, 30 grand on this property. That's adjusting my active side. I'm adjusting my gross income this way, not having to pay taxes on it. And 2 years later, I can 1031 exchange it into another property and do it again. I can run a cost seg again on this and get the bonus depreciation and then do it again from property B to property C. So what was interesting, I heard White Coat Investor say, depreciate, exchange, depreciate, exchange, depreciate, die. So you never recapture this. When the assets transfer in the trust, what's that called? When you inheritance, it takes on a new value and you never have to recapture that appreciation.
Yeah. Yeah. So generational wealth, real estate's the go-to for that reason. And everything else we just discussed too.
Depreciation. I was so excited about depreciation before. It's a good time to talk about depreciation because this time of year, no matter how much you prepared the year before, if you are a business owner, investor, this is the time of the year when things start moving and shaking. And hopefully in the last year, if you run your calendar year at the December 31st, now is tax time, right? And I suggest, as this airs, it should air pretty close to when we're recording. It's time to get up and get after it. Don't be the person that's waiting and hesitating. Yeah. Don't be a procrastinator.
Yeah. I don't want to be that person.
Yeah.
Well,
depreciation. Go ahead.
I was just going to say, with that being said, is there anything else on top of what we've already discussed with the benefits of investing in passive or investing in real estate for passive income?
Absolutely. Appreciation.
That's right. Yep. Almost
appreciation. Forgot. Yep. So on the bottom side of that stackable return, I say appreciation. I put that on the bottom because, like I said before, in the world of real estate investing, the magic happens on the acquisition. Acquisition must be an equation for you. It must not be emotional. You got to make your money on the acquisition. You realize it either on the sale or on the longevity of the hold. And when I say appreciation, and I mentioned that it's not emotional now because I'm not going to take that into account. I'm not going to project the inflation rate. I'm not going to multiply it by, this mark. I'm just going to keep it simple. And it's worked for, decades and decades this way. I'm not going to take account appreciation of market value. I'm not going to take into account appreciation of rent. But what happens? Market value appreciates, rents appreciate. And we looked back at a study, and if you look, just generally speaking, every 15 years, from what I'm seeing on the studies that we looked at, you can almost see a double in rents. That's pretty incredible. And on that same 15-year period, in the markets that we're in, we're seeing easy 6-figure appreciation. And we're in stable markets. We're not in markets, explosive markets. We watched one market here in the last 3 years, Charlotte, North Carolina, explode. Like we watched, it was so crazy. We would, because we're direct to seller in the acquisition company, and we would call and talk with sellers. And sometimes it took months really to get to a price or an agreement, or the seller finally makes the decision to move on. It take months. And we watched the values of these properties increase so fast during those time periods. Now, Charlotte is an explosive market. It is the 15th at the time, 15th largest city in the nation, and it is the 5th fastest growing in the nation. We moved to the area about 6 months ago. And at that time, I believe there were 81 people moving to Charlotte every single day.
Yeah.
That's where explosive growth comes in. And that's where the appreciation comes in massive. We're even in the stable markets that we're in, we're not seeing explosive growth, but we were also seeing 6 figures of appreciation in the 15-year period. We're seeing rents almost double in a 15-year period. Pretty incredible. And we don't take that into account on acquisitions. So when you have that in 15 years, guess what? You're pretty happy.
Oh yeah. Yeah. Especially when you don't calculate it in. So it's just a bonus when it happens, which it will.
Yep. And as far as any other benefits, I mean, I think that's the easiest way. If we just stayed on this, we talked about a couple of sistering benefits or benefits that build off of these other ones. But this is the basis, Thomas. I think this is a great way of looking at it. The benefit of real estate investing for passive income is the stackable returns, the cash flow, principal pay down, depreciation, and appreciation. I think that's the easiest way of looking at it.
Yeah, I agree. Well, I think that can wrap this episode up. Brett, if you don't have anything else to share with the benefits.
I got a lot more to share, but we don't have time. We've got everybody's attention here for this short period. I just want to thank everybody for listening. Getting out on these episodes is great. I love sharing. And if you guys want to reach out to us, check out the book, How to Get Rich as a Doctor. There's lots of resources in there. We are very passionate to share the resources, the experiences that we do have with you guys and ladies as well too, and help you take those steps, whether you're a med student, whether in your residency, whether you're 10 years out, whether you're at, this side where you're looking to retire now. We'd love to connect with you. There's ways in that book. You can pick it up on Amazon and connect with us.
That's right. That's it for this episode. Thank you guys for listening. This is Thomas signing off.
Don't have a good day. Have a great day.
Have a great day.